Good morning. This is Dr.S.Valluvan from MBA, Dr. S.N.S. Rajalakshmi College of Arts and Science. This is a video about the topic of cost of capital in financial management. So, what is cost of capital? It is a method of accounting for returns on an investment that helps an investor to offset the cost. It enables the investors to detect any risk or loopholes in the process that might lower their returns and increase the risk. The weighted average of cost incurred in employing capital helps to know a company's value and the risk for an investor. The higher a company's debt, the greater the premium or returns demanded by investors. The weighted average of the equity or debt capital invested reflect the total premium cost company owes its investors for the risk taken. First, let's understand the components of cost of capital. Cost of capital is a combination of debt plus equity. The cost of equity is nothing but the cost incurred in the issue of shares. It's a common shares. What sort of cost will incur when a company issuing equity? The company has to give a dividend to their shareholders because the shareholders will expect some sort of return from the company for which they invested their money in the particular company. So the company has to compensate for the time for which the shareholders put their money in the company's investment. This is what we call cost of equity. Coming to a cost of debt. Cost of debt is nothing but the cost incurred for the company to give return to their bondholders or the debt holders. As far as the cost of equity is concerned, the company has to give the dividend to their shareholders. As far as the cost of debt is concerned, the company has to give interest to their bondholders. Actually, the debt is more cheaper than the equity. This slide depicts the mechanics of computing the cost of capital. So what are the weights that we attach to a debt and equity? Debt and equity. See, the cost of equity multiplied by weight of equity, adding cost of debt multiplied by weight of debt, we'll be getting a cost of capital. We'll see one by one. In the mechanics of computing the cost of capital, the first we have to find out the cost of equity of the company. It is derived from the CAPM model, capital asset pricing method. In a CAPM, risk-free rate plus beta into risk premium. So first we have to calculate the risk-free rate. Here there is a question arises. What should we use as the risk-free rate and what equity risks are rewarded? Should we scale equity risk across companies? How do we measure the risk premium per unit of risk? So for all these kind of questions we have to derive the answers. Then we will be getting the cost of equity for the company. Next is cost of debt. when we calculating the cost of debt, as I told earlier, cost of debt is more cheaper than the cost of equity for a company. So risk-free rate plus default spread and 1 minus tax rate, that is a tax benefit that the company is getting when they issue bond or when they're borrowing money. So tax shield, the company will be getting a tax benefit. So as far as the mechanics of computing cost of capital is concerned, cost of equity plus cost of debt will be getting the cost of capital. In investment analysis, the cost of capital as a hurdle rate or an opportunity cost. Now, what do you mean by hurdle rate? Hurdle rate is nothing but is a benchmark for taking investment decisions, whether to invest in a particular project or not. Of course, the hurdle rate should reflect the risk of the investment, not the entity taking in the investment. Should use a debt ratio that is reflective of the investment's cash flows. No risk subsidies if you use the cost of capital of the company as your hurdle rate for all investment. Risky investments will be subsidized by safe investment. No debt subsidies fund an investment disproportionately with debt. You are using the company's debt capacity to subsidize the investment. As we see earlier, the capital structure by cost of capital as an optimizing tool. As you borrow more, as a company borrow more, the equity in the firm will become more risk. As a financial leverage magnifies the business risks, the cost of equity will increase. As you borrow more, the default risk as a firm will increase, pushing up the cost of debt. So at some level of borrowing, the company's tax benefit may be put at risk. As I told earlier, for a cost of debt, the company can enjoy the tax benefit, but at some level of borrowing, the tax benefit may be put at risk, leading to a lower tax rate. Because there is a limitation for everything. If a company keeps on borrowing money from the bank or financial institutions, means that will be risk for a company, because the debt equity ratio will get increase. As a company use more debt and replace more expensive equity with cheaper debt, but also increases the cost of equity and debt. The net reflect will determine whether the cost of capital will increase or decrease or both unchanged as a debt ratio changes. The optimal debt ratio is the one at which the cost of capital is minimized. The cost of capital is a benchmark which can be used in dividend policy and in valuation also. It is a mechanism for adjusting for risk. The last slide depicts about the cost of capital. What the cost of capital is not? It is not the cost of equity. Cost of capital is not the cost of equity, because as I told earlier, cost of capital is a combination of cost of equity plus cost of debt. So there is a time and a place to use the cost of equity and the time place for the cost of capital. So we cannot use them interchangeably. And it's not the return that you would like to make. It's not receptible for all your hopes and fears. Thank you.